Hello again. Welcome to another episode of the Uranium Market Minute. Today is Wednesday, April 13th, and this is episode number 105. My name is Justin Huhn. I'm your host. I'm the founder and publisher of the Uranium Insider Pro Newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. As always, nothing in this video is intended to be investing advice. I am not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing and always take responsibility for your own choices. All right, thank you so much again for being here. Really do appreciate everybody. If you've been enjoying these videos, please do like this video, share it around, subscribe to the channel, hit the notification bell. You will be notified whenever we publish a new episode, which is just about every day. We will not be here on Friday. It is a market holiday in the North American markets. In fact, I think most markets are closed on Friday, with the exception of the ASX, which technically would be Thursday evening for me. So we will not be here Friday. So I get a 3-day weekend. All right. Of course, it's not all restful. We do update the weekly watch list every Sunday for Uranium Insider Pro members. And there's some interesting charts that I'm going to share only with members that I think are highly relative to this market right now. So I just wanted to do a little bit of housekeeping there. Again, Monday, the 18th, that is this coming Monday, we will be having our April members webinar. And again, we have a special guest that represents one of the companies that we recently positioned in, a position that we're very excited about. So if you are a member, we do look forward to seeing you there on Monday. If you're not a member, even a quarterly membership will give you access to these webinars. So if you are interested, there will be a link in the description below. You can also download a free newsletter sample from another link below that I will put in the description if you want to get just a quick basic idea of the type of content we put out on a monthly basis. All right, so I want to talk about a little bit of the history of this market and what brought us to this point, and then I'm going to speak about that in the mailbag section. I had a question coming to me via email the other day that led me to want to speak about this. So I'll get to that in the mailbag section. Not much really to report in the scoreboard, so we're going to run through that very quickly. The charts are holding up very nicely. Really encouraged to see intraday dip buying happen. This sector is very strong right now. So we'll show you that as well. But jumping right into the daily scoreboard, the spot price of uranium is just holding here, $63.75 a pound mid-market. Spot raised a tiny $190,000 yesterday, but did not buy any pounds. We are seeing the spot market hold up very well with a small amount of purchasing, relatively speaking, coming from spot. This is a good sign. Just to reiterate, their year-to-date total stands at 13.5 million pounds, and they've raised 750 million in new capital this year alone. If we go back to last August when their ATM went live, they've purchased roughly 1 million pounds a week, almost. Huge numbers coming from spot. They're sitting on 65 million in cash. The ETFs, however, a little bit more to report here. Yesterday, URA reported an astonishing one-day increase in outstanding shares of 2.05 million shares. So again, and URNM reported no change. We do believe that the vastly outpacing of URNM in terms of outstanding share issuance by URA has a lot to do with the options market. Whenever an entity takes a bullish options position, the market maker that sells that options position is actually net short by doing that. They are not going to be net short. They make their money on the spreads. So they are not going to take a bullish or bearish position on anything that they're buying or selling. So a market maker that's selling, let's say, a call option in URA is going to go ahead and purchase the underlying common stock. That puts buying pressure on the stock. And URA also at this point is still a little bit better in terms of liquidity. So institutional players might be able to position more in that than in URNM. However, with Sprott recently taking over URNM, we believe that that is going to change. We believe that we are at an inflection point for URNM relative to URA in terms of outpacing their assets under management, especially if URNM can increase liquidity, which we believe a stock split will really help with that. We don't know if they're going to do it. We're encouraging them to do a 3-for-1. And that would be a very good sign that would bring them in parity in terms of price for the actual unit, pretty close to URA. And of course, that'll improve liquidity, it'll improve trading volumes, and it will deepen the options market, which of course, as I just mentioned, when things are going in a bullish direction, puts underlying buying pressure on that common. So looking out for that, I'm hoping that that will be the case. So the inflows from URA alone yesterday led to $40 million in new mandate buying. So 2022 year to date, the inflows into the two ETFs has given rise to 748.5 million in mandated buying of their underlying holdings so far this year. Astonishing. So I hope that you can see the clear flywheel effect that we are seeing here. The purchasing into these ETFs, not only does that obviously lead to purchasing of the underlying holdings, but one of the underlying holdings is the Sprott Physical Uranium Trust, which then takes that purchasing pressure, shares issued on the ATM when they're trading at a sufficient premium to NAV. They go out and they buy physical pounds. That puts pressure on the spot price. Rising spot price puts pressure on the equities because that's what the investing community watches. So we've got a double flywheel going on here. All right, so let's go ahead and take a look at the charts. Like I said, pretty encouraging chart action here. URA continuing its uptrend. Nice follow through on that golden cross, the 50-day rising sharply above the rising 200-day. Now it's strongly above even the 20-day moving average. We saw the stock open up a couple of percentage points, sell off throughout the day. It rose up, it sold back off, and then we saw dip buying come in. That was very, very good to see. And we saw this across the sector. Some of the stocks were actually in the red intraday, turned around, and almost the entire sector closed in the green. We, again, are still moving up in this next leg up within this Livermore accumulation cylinder that I've highlighted many times. We're seeing a big new block of volume, although we need more volume to come in my opinion, in order to take us up towards the top end of the cylinder. I wouldn't be surprised if we see a pullback between this move from the bottom of the cylinder to the top of the cylinder, but clearly we are in a bull trend here. And if you think that this is over, why don't we zoom out a little bit and look at the weekly chart for URA. Now, again, I've highlighted in the past how if you look at charts for some of the individual equities, that it gives you a false impression of the potential going forward because the share issuance is different. And that also is the case in terms of URA, but now we're at an all-time high in shares outstanding. But even with that considered, on the run down, there is redemptions of shares. So URA will represent a potential move better than most equities will because of that redemption factor that you just don't see. You don't really see stock buybacks by mining companies in a bear market. So that's looking at that, it's just, you can tell we are very, very early in this trend, very early in this trend. And you can clearly see the volume happening here. Now I can't zoom back further than this because that was the inception of URA was actually in late 2010. So that's as far as back as we go. We can't see the previous bull market. But this is a really beautiful chart here, and I'm looking forward to this market going forward. Looking at the Sprott Physical Uranium Trust, let's look at the daily chart here. Actually sold down on the day, down 1.2%. They closed at a discount to NAV yesterday, so probably didn't buy any more, issue any more shares in the market, raising more cash. Possible they were in the market buying pounds. We'll have to see. Looks like this is time for a slight correction. Maybe we go back down to that 20-day, get to maybe a 5% discount to NAV. The equities are stealing the show right now. The equities are in very, very strong uptrends, especially compared to the spot price of uranium. This is something that we highlighted to our members. This is last week when we entered a new position in a uranium equity, and we highlighted that we believe that the turn is here in terms of equities outperforming spot. And that is likely what we're going to see going forward. And this is going to cycle back and forth, back and forth, back and forth. Of course, there's always much more leverage in individual mining stocks than the actual commodity itself. But the actual commodity itself is probably going to be far less risk. And in terms of spot, they have great liquidity. So it still is a very great, safe and highly liquid vehicle to hold for exposure to uranium. But of course, the equities have that extra juice, and we're always looking for leverage. So we gain that in terms of our focus list portfolio for the Uranium Insider Pro Newsletter. We are primarily exposed to equities, and we also add even more leverage in options plays. We are in a vertical call spread, a bullish call spread that we entered a couple months back. The underlying equity is up about, let's see, I think it is up about 25% since we entered it, and we are up about 75%. So max leverage with that, and that bull spread really starts to print towards the end of its life. Those are some of the types of leverage that we give to members that I don't really discuss those exact positions on this podcast. All right. So the question that came into me had to do with oversupply. And that also leads into something that was sent to me as well that I wanted to kind of tie those two things together in this mailbag section. So somebody sent to me that Jeff Curry, the head of commodities at Goldman Sachs, he commented the lack of investment in commodities is now showing up in supply shortages and higher prices. Okay. So most of the time when the mainstream outlets are talking commodities, typically that they're talking about oil and gas. But in this case, Goldman Sachs actually just came out publicly, it was last week or possibly the week before, that they are long physical uranium. Goldman Sachs has been buying up SPUT, and I believe they've also participated in other raises across the sector. So Goldman is long uranium, and that's a really big development in and of itself. But when we talk about underinvestment leading to supply shortages and higher prices. Okay. So obviously in the oil and gas space, that has to do with, a lot of that has to do with ESG, environmental social governance, and fossil fuels not necessarily being part of that ESG approved investments. Now, nat gas was part of the green taxonomy for the EU, along with nuclear. But generally speaking, there's been an underinvestment in oil and gas. A lot of that has to do with a US shale, which a lot of commodities analysts that know a lot more about this space than I do believe that US shale has already peaked and is unlikely to go back up to levels it was producing at even a few years ago. But money just flew out of that sector when oil traded, especially when oil traded down to negative prices in March 2020. Then we had just a long period of time where the investment really didn't come back, whether that's due to COVID, whether that's due to ESG mandates, whether that's due to a general overall belief that the West moving swiftly towards a 100% carbon-free future by 2050, which absolutely is not going to happen, by going all out renewables, that the investment flooded into renewables rather than into oil and gas. So what are we seeing now? We're seeing not enough production to meet demand. We're seeing obviously geopolitical tensions that are having huge implications for the flow of oil and gas, especially from Russia into the European Union and elsewhere. And we're seeing huge price increases, oil above $100 a barrel, massive increases in the price for natural gas. And of course, this is going on across the commodities sector. General inflation, underinvestment in these spaces for a very long period of time, demand remaining higher than was expected. So we have just kind of a classical supply demand situation on top of inflation, on top of geopolitical strife, and probably what some are calling peak globalization. Many believe that we have peaked in terms of globalized industry as of the last few years, and now we're going to go more towards nationalized, not nationalized, but nationalism in terms of commodities production and industry. And I think that that is a trend that is literally just beginning and is probably going to continue for a number of years, if not indefinitely. So and we're on the front end of that trend. So you can look at charts for, commodities ETFs that are mostly or entirely exposed to oil and gas and say, oh, okay, we're already 2-3 legs into this run. It's like, this commodities run, I think, is going to blow people's minds. I think it's going to go to levels that are far beyond what anybody is expecting. And it has everything to do with this flip from globalization to nationalization and rising inflation. CPI yesterday, it came out 8.5% in the US. We all know that's higher than that. This is affecting many countries across, around the world. And this is a trend I believe is going to continue. Okay, so how did we end up with underinvestment in the uranium space? In the early 2010s and late 2000s, early 2010s, we had Kazakhstan ramping production year over year, huge increases in production. Why? A couple of reasons. At that point, Kazatomprom was 100% state owned. Okay. So they had really no incentive. They had no accountability towards shareholders. They had a mandate to produce. They have what's called subsoil use agreements, which they still have. This is essentially a production license that not only allows them to produce a certain amount, but essentially mandates that they produce a certain amount. They're allowed to go within 20% in either direction of those subsoil use contracts. So Kazakhstan produced year over year, ramping up massively. And what happened also at that time, the tenge depreciated very drastically. And so their production costs are in tenge and they sell in the US dollar. So relative to the US dollar, the tenge was crashing and they continued to ramp and ramp and ramp. What also did we have? We had Japan shutting off all of their reactors, all 54, one fell swoop, 10% of global demand offline like that. Germany beginning to phase out. South Korea saying that they would be phasing out, which they did start to phase out. Now that is turning for South Korea. That is fantastic to see. Now Japan is restarting. Of course, that's good to see. I spoke about that in depth a few episodes ago. Now we're seeing a number of countries reverse course on keeping their reactors online longer. That is, we've seen France do life extensions. The US has done a number of life extensions. The UK is talking about life extensions and expanding buildouts. They're talking about building another 6 to 8 reactors by 2035 in the UK. France is talking about 6 reactors plus potentially another 8 by 2035. So we're seeing this completely turn, but that overproduction primarily coming from Kazakhstan in the early 20 teens into the mid 20 teens, while we had reduced demand, crash the price of uranium. And of course, when the price is in a downtrend, and at that point, the mid 20 teens, nobody really knew how long it would take this to turn around. Of course, the uranium equities would tell you that, it's just around the corner. The price is unsustainably below the level, the cost needed for production. And that was true, but that didn't matter because there was a ton of above ground mobile inventory that had to do from that came about from overproduction for years and years and years. So money does not flow into the mining companies, into exploration, into development when you're in a downtrend for the commodity with no end in sight. So the money absolutely did not. The companies had a very, very hard time raising cash. They had, loyal investors, a couple of very contrarian entities would take place in these share issuances, in these financings, where they had to dilute the heck out of their share count, had to destroy their share structure, had to give away, long-term full warrants with each financing. And that was a hard way to bring money into the space and certainly wasn't sustainable in terms of putting that money into the ground, drilling, exploring, finding deposits, let alone developing. Now we're finally seeing a few companies be able to raise money to get into development. We saw Paladin do a big raise. They're getting their Langer Heinrich mine that is on care and maintenance. That's about 5 million pounds a year. 20% or 25%, I'm forgetting, I think it's 25% of that will go to the Chinese. They expect, now that was a previous producing mine. That's not going to be producing until 2024. Okay. Almost 2 years until they're into production. And that is a mine that's already developed. So this sector takes forever to respond to price moves. This is why the price can spike so hard and so far. The levelized cost of production, especially on the margin, is very high, much higher than where we're at right now. We're probably talking $80 to $100 a pound just to bring some of those projects onto the margin, even into consideration for taking on the risks, the capital risks for going into development of their projects. Okay, so we need those prices. We need those prices to sustain for some of these projects to come online. And then, of course, the price is going to drastically overshoot because it's not just the production cost needs that are dictating the price movement. It is financial players. And I don't know if you know this, if you paid attention to financial markets in terms of investing over the past couple of decades. When there are financial entities, let's say financial investors and speculators, when there are hedge funds that recognize that they have a market, I'm not going to say cornered, but when they recognize that they can severely influence a market with their funds, they can absolutely go for the jugular. And I think we're approaching that moment. We're approaching that moment for uranium. And I don't think anybody knows how high this is going to go. I don't know how high it's going to go. I'm going to tell you right now, it's going to overshoot the marginal cost of production. By how far, that's up to the financial players. So that's very exciting. That's just around the corner. That's what we're positioned for. And like I said, we like safe leverage. We don't trade on margin ever. We never recommend that, but we like these intelligent options trades that can do a 3 or 4x above what the underlying stock can return in a reasonable time frame. And they're absolutely killing it right now. So I thought I would just highlight a little bit of backstory on what led to that oversupply. That oversupply took a long time to work through. It is worked through at this point. Okay. Let's say 150-ish million pounds of oversupply that didn't go to China from the previous decade, we're through it. We're through it. Some of it is still around. Those sellers, those would-be sellers, are hanging on to that material right now. Clearly, the market is quite thin here. So it's exciting to be in this place where the basket of uranium that was held over for such a long period of time, that the carry traders were able to make available to utilities for a very long time. So the carry traders actually played a big part in working through that mobile inventory that was sitting above ground from the previous decade. Now that we're mostly, if not entirely, through that, now it's just up to the financial markets and the utilities coming back in force into the mid long-term markets, which they are. That is happening. Our sources are telling us that the long-term market is back. Now, is it back like 2006? No. Are we seeing the Chinese sign, what was it, 200 million pounds in a matter of a couple of weeks? No, we're not at that level yet. We're not in panic mode. Will we get to panic mode? I don't really know. I will tell you this, the market is fragile enough and it is in a place where some type of exogenous event, in addition to what we're already seeing, could absolutely crash this market. And when I say crash this market, I mean for utilities, it would break the market and the prices would go on an absolute moonshot. So let's just say if something happened to McArthur River mine during the restart, utilities are already expecting that mine to come online. Okay, that's going to be 15 million pounds in a couple of years per year. That's a big mine. If something were to delay that, in 2005 or 2006, that mine flooded. The mine flooded, and that was one of the reasons why we saw a rush into long-term contracts and big spikes in the price. That could happen. This market is fragile and it's ripe for disruption. Now we've seen some disruption come in already. Disruption of Russia invading Ukraine and the West essentially not accepting their pounds at this point. So anything could happen here. Anything could happen. It's a very fragile market, and we position in that not only for the supply and demand fundamentals, but because of its fragility and the strong potential for disruption. All right, that was a little bit long-winded. So if you made it this far, congratulations. Thanks for being here. I will see you again tomorrow. And then, like I said, we will not be here on Friday. We'll be back the following week. Next week will also be a short week because I will be out of town towards the end of the week, but we will be here Monday, Tuesday of next week. All right, be well. Again, if you are interested in a sample newsletter, click the link in the description below. We will send you a previous month's newsletter and you can get a better idea about the type of content we put out. We live, eat, and breathe this stuff. We love this market and hope that these videos have been helpful. Take care. Cheers.